Israel started, we didn't see a significant jump in the volatility. It moved from 11 to 13 and again back settled to the 11 odd levels. So that is first, when we look into the volatility index, it doesn't give us a very meaningful signal at this juncture. Same is the case with this CBOE volatility, which is hovering around 1920 kind of trajectory, which is again at a very, I would say, average level. Not a big surge is being seen in the CBOE volatility. Now coming to the Hamas Israel war situation. So I'll give you a few data points. So as far as Middle East is concerned, if you look at Middle East used to be a 36% kind of world's oil supplier a decade back. Now, if you look at the same, Middle East today, it contributes close to 30%, which means there's a meaningful drop in the contribution which Middle East used to do from 36% to 30%. But yes, obviously it is still a meaningful player, but that has come down. Second thing is that India imports close to almost 84% of its crude oil needs. And the top 10 oil exporting countries, they do almost 75% of the world oil exports. Now, keeping this in mind, I think this Hamas issue and Israel issue, so they are not. So Israel is not a very big producer of oil, but the only challenge which market wants to see is whether this escalation is going to see Middle East getting more involved in this entire geopolitical war risk. And if that happens, then everybody's concerned. And in fact, World Bank has said that if this happens, then they want to draw a parallel line. So 1973 there was an oil embargo. In that situation, we saw a very, very significant jump in crude oil prices, and that is what they have done analysis that if this war escalates and gets involved, then there is a possibility of a 75% hike in the crude oil prices, which means crude can go somewhere around 140, 150 odd dollars if this escalates further. But if you look at the data, so crude in fact has corrected from almost $95, $96 in Brent crude. It has come down to $80, $81, which means in the same period when we are seeing this escalation happening, we are actually seeing a significant drop in crude oil prices, which means we are not seeing some significant jump there. Second, as far as India is concerned, India has been importing a lot of crude from basically Russia. So if to give a data point, we import almost 42% of oil imports from Russia, which used to be just 1% a couple of years back. And this oil imports which we are doing was basically at a significant discount. So at one point of time, we are having a 20% discount to the global benchmark of crude prices from what we used to import from Russia. Obviously, this discount has now narrowed down to single digit, but that used to be 20%, and that's the reason our import bill has actually come down significantly. So just to give you a data, we have our oil imports has come down almost 29% year on year to $6.34 billion, which used to be almost, I would say, at some point of time, $93 billion. So there is a significant drop in the crude oil import bill. So keeping this all these things in mind, actually we are not seeing some kind of significant jump in crude oil, and ultimately, if you want to see if the crude goes up, obviously inflation goes up. It will result in the commodity prices basket will see a significant trend. Shipping costs will go up significantly. Agriculture costs will go up significantly because the fertilizer costs will go up significantly. So we are observing this very, very closely. I think RBI has said that we are comfortable with a 90-95 kind of band of Brent crude. If we go significantly above $95, then only I think there is any serious concern which we are going to witness because of crude. But looking into the current scenario, both the data as well as the reflection of these data into the price behavior of crude oil or other commodities. So we have spoken about crude in detail, but if you look at aluminum, copper, zinc, lead, steel, everything has corrected significantly in last 6 to 9 months time frame, and there is no significant jump in the prices of any of these commodities. So which gives us a signal that inflation is going to be under control, and we are watchful of the of these two important triggers, whether crude crosses $95 or Middle East gets involved into this escalation.
And what about China's slowdown, Ashish?
So again, China is having its own set of problems. We have seen a debt to GDP of China growing up very, very significantly. We have seen property prices, tumbling down in China. So that is also going to result into a lot of default. So just to give you a perspective, China is going through a phase which India, actually witnessed during its IL&FS crisis. So the same situation is actually going on in China. Now, if you look at China's one more important data point which I want to highlight is China almost does an export of almost $250 billion pre-COVID. Now, if you look at currently, this data has come to almost 285 to $300 billion, which means actually post-COVID there were a lot of concerns whether China is going to lose the export market share and all those stuff. But actually, in an absolute terms, China is growing its exports from $250 billion to $285 billion. Now, why we should not be worried about China still having a good market share in export is India currently does almost $35 billion USD per month kind of export. But important part is India is focusing on value addition. So where they want to do quality exports, where we will have a very standard manufacturing capacity, so the value added business will gain a good amount of margin. There will be a lot of quality job profile which we are going to start, and for that government has introduced some very good initiatives. One, the taxation rate has come down to 15% for any new manufacturing setup. Second, government PLI schemes have been introduced, whereas production linked incentives, where almost 14 sectors have been covered in this production PLI scheme, and government is incentivizing almost 2,50,000 crore in this PLI schemes, which will result in a capex of almost 4.3 trillion capex will be done in the next 3 to 5 years, which will result in a 31 trillion sales, and it will do a value addition of almost 11 lakh crore. Now, if this happens, our identity as a manufacturing hub of high quality and value added products will become very, very significant. Second, the IP laws of India are very much respectable. So if you look at every year, we file lot of new patents, which will distinguish us as a manufacturing partner for a lot of global MNC companies, not into the, I would say, entry level product, but into value added product. The recent example could be something like mobile exports. So if you look at a decade back, we were a net importer of mobile, but in just, I would say, last year we were doing a export of or production. We were exporting mobile to the tune of 45,000 crore. But 2023 we are doing an export of almost 90,000 crores. So from a net importer, we have turned exporter, and that has also doubled in last 1 year's time frame. This number is going to cross 1 lakh crore in financial year 24. Same way, you can remember example of specialty chemical. So China used to control almost 35% market share of specialty chemical, whereas India used to have just 2% market share. This was 2014-15. Now, if you look at in the 8-year time frame, India is controlling almost 5 to 6% of specialty chemical contribution, whereas specialty chemical is a value-added business where we have very strong margin profile for most of these companies, and that's the reason. In the last 7-8 years, when markets were more or less stable, struggling with COVID, demonetization, rising interest rate, the biggest wealth creation actually happened into specialty chemical companies, where companies like SRF, Navin Fluorine, they almost grown up 7 to 8 times in the 7-8 year journey because of this big size opportunity which emerged due to China Plus One. Now, the same kind of story is happening into electronic manufacturing space. So if you look at the EMS space, electronic manufacturing space, the total opportunity size is close to $880 billion globally, in which China controls almost 47% of the market share. And where is India? So India is at just 2%, hardly 2% kind of market share, which India has in the EMS space. So we are typically doing $18 to $20 billion kind of EMS opportunity. But in next 5 to 7 years, we are talking of 100 billion USD kind of production we are going to do in the EMS space. Why? Because again, there's a 14th PLI scheme which has come into the hardware manufacturing space. So we are going to do printed circuit board, we are going to do black box, and a lot of stuffs in the electronic manufacturing space. And this will again give a very good opportunity for job, employment, and value-added business to be done in India. So our sense is that China's slowdown is actually India's advantage. If you look at FDI inflows, the FDI inflows has become negative this year in China. Whereas if you look at India, India has been consistently seeing a significant jump in FDI, FII flows, and that is also a very strong signal that because of stable currency, stable foreign exchange, a lot of manufacturing setup being done in India, we think that India can do extremely well even in an environment when China is slowing down. One more data point I would like to add, Lina, is that China is moving from a manufacturing hub to a service sector. So even if they do good, uh, their weightage in the overall global environment is not going to be witnessed a lot, because service sector you will do good value addition, but it is not going to increase the turnover very, very significantly. And that's where China is shifting from manufacturing to service sector, whereas India is in the reverse path. We were into service sector, then then the economy shifted to consumption based economy, and now in the last 3-4 years we are talking about India becoming a manufacturing hub. So that's the reason when recent budget we announced almost 10 lakh crore kind of capex budget by center, state put in almost 5 lakh crore, and private enterprises are putting in almost 8 lakh crore. So there's a 20 to 23 lakh crore kind of capex being done. So we are shifting from a service consumption led economy to a manufacturing led economy, and that's where we think that India is going to gain a lot of traction because of this shift which is happening from China to India.
Great. Now, speaking of stability, you mentioned the word stability. So on the domestic front, Ashish, which sectors, and just name the sectors, we don't have to deep dive into them right now, but which sectors do you think will get impacted the most by the state and general elections that are expected over the next 6 months?
So yes, Nina, so I think before coming to the sectors, because first we'll like to give us a few data points which we have in our mind. So we have considered almost last 6 elections, assembly elections, where so let's take an example of 1999 elections. 6 months before this general election, we saw almost 36% rally in the market. In 2004, before election 6 months, we did almost 9% rally. In 2009, it was 31%. In 2014, it was 19%. And in 2019, it was 11%. So in all these, situation, in these events, we have seen a pre-election rally. Now, again, we are in May 2024. I gave you a data point that India VIX is at a multi-year low. Crude has actually corrected significantly from 95, 96 to $81, which is a great, positive news for Indian markets. And this 6 months away, we have election. So whether market will see a rally or not, this data indicate that there's a good possibility, the election rally can be there in the market. Now, if you look at these 5 assembly elections, they constitute almost 15% of the total Lok Sabha and Rajya Sabha seats. If you look at, in 2019, Madhya Pradesh, Chhattisgarh, Maharashtra, in all these 3 states, actually BJP lost, and we had a very bad results from a state election. But 2019 general elections, we saw clear victory of BJP. So my sense is yes, a lot of people consider that these assembly elections are as a semi-finals to the upcoming Lok Sabha elections. But this data clearly indicate that generally these state elections have not created any kind of significant price volatility in terms of market behavior. Now coming to the possibility, so it's very difficult to get a sense that whether which party will come into power. But one thing is very clear: there's a strong popularity for the current Prime Minister Modi. There is a very minimal impact of India alliance. This is what we understand. And considering that a lot of states are pushing for populist measures, we believe that in this union budget, we will see some strong populist measures which will be done by the central government. Obviously, it is going to see rise in the fiscal deficit, which is currently at 5%, 5.9% of the GDP. So we might see some rise in the fiscal deficit number. But considering all this, there is a very strong possibility populist measures will be taken, and this will result in the rural economy coming back into a consumption spree. So all this clearly indicates that we are not seeing any kind of significant volatility because of elections. But yes, in case if there is any disappointment in terms of the election results, then I think infrastructure will be the one sector which will be most impacted, where there will see a lot of the order book will come down significantly. There will be delay in payments because of this. A lot of ancillary sectors like cement, steel, real estate, they will come under stress. So I think the entire capex and manufacturing theme, which is gaining a lot of traction in last couple of years, that could come under some kind of medium term pressure. So yes, I think if there is any negative surprise, then infrastructure, capex, manufacturing, real estate, steel, cement, these are the sectors which are going to be the most impacted sector, at least from a short to medium term perspective.
Understood. So now then, Ashish, tell us that we know that there are global reasons. There is a event risk that is waiting to happen with the elections and so on and so forth. So how should one manage risk in a volatile environment in our portfolio?
Sure. So Lina, I can tell you about our style of investing, which we call as FTPM approach, which is basically fundamental technical market dynamics in psychology. So there we try to understand the market both from a fundamental perspective as well as how the markets are reacting to the news flow and events, and what is its reflection in the price behavior. So in these parameters, we try to do three kind of things to manage the volatility. One, we create there is a sector rotation. So I'll give you an example. From 2014 till 2023, almost I would say 7-8 years, pharma as a sector didn't give any absolute return. Same is the case with auto. 2017 it peaked out. It took almost 6 years for auto to come back to the same level. So it means 6 years there was no returns in the auto sector. But in the same period, actually markets have given a very meaningful return, which clearly indicate in our market, and because of the lot of diversification which is happening, which is there in our market, there's a lot of sector rotation which happens. So as I was giving you a data point, specialty chemical gave almost 7-8x return in the 7-8 year journey. This was a time when demonetization was a concern, when COVID took place. A lot of other interest rates and everything was going up, all this, but the wealth creation actually happened in specialty chemical when markets were witnessing a lot of pressure. So which means there is a lot of sector rotation. So we need to understand which sector is gaining attraction, which will be understood not only from a fundamental perspective, but we'll try to do long-term technical price performance behavior, the relative strength, where is the sector rotation happening. There is a concept called as a relative strength, and basis that we try to understand which are the sectors which are gaining traction and which are going to see significant underperformance, so that we can cut our exposure to those sectors. That is one way to manage a risk. Second is, if there is an event risk like COVID, then we don't have a much option but to create some amount of cash in the portfolio. But the problem of cash is it's very difficult to redeploy at a lower entry point or a lower entry price, which means you can't create a cash of a significant cash. You can do 10-12% kind of cash creation, but if you do 25-30%, then it can backfire also. So for that kind of risk, we have our best friend, which we call as a friend who will help us in reducing the risk, which is called as hedging. So rather than creating too much of cash call, we try to hedge the portfolios by buying put options. So in PMSs, you have a very limited option. You can hedge through Nifty puts only. You can't do a one-to-one hedge with stocks, but it will give you a relative kind of safety. So let's say if tomorrow market corrects 10%, and if you have a hedge which is almost 100% hedge in your portfolio with a cost of let's say 1%, So even in a 10% kind of downside which you witness in the market because of hedge, your downside is not going to be more than 2-3%. Even considering your portfolio has a high beta, stocks in your portfolio. So hedge is something which gives you a very good, tool to manage your risk in any kind of uncertain or volatile environment. One thing is in event risk. Second is certain events you don't know what will be the outcome. So let's say election are those kind of events where you don't know what will be the outcome. So you have to buy the hedge before the event, before the election results, so that in case if something goes wrong post results, you have hedged so that on downside, if the market corrects, you will protect or give us a reasonable protection of the portfolio. In case the market goes upside, what you are paying is a nominal premium, which will get lapse, and still your portfolios will do reasonably well.
Thanks, that's very helpful. And also, I mean, these are volatile times, which means it can also give a lot of opportunities. So how can investors get a higher win ratio in their stock selection?
So as I mentioned, we follow approach called as FTPM approach, which is fundamental technical, market dynamics and psychology. So as we see that in the market, there are few sectors which are gaining a lot of traction. So let's take a case of last 7-8 months. Anything which is related to capex, manufacturing theme, railways theme, we have seen maximum wealth creation happening in those spaces. But if you are into any kind of pharma stock, or let's say diagnostic space, or something like value stocks, we have not seen some significant price appreciation. Despite markets have moved from 15,500 to almost 20,000 kind of trajectory, there are many large cap stocks which have actually underperformed the market in a significant manner. Let's take an example of Nifty 50. So Nifty 50 has delivered a return of hardly 6-7% in last 7-8 months. Whereas if you look at the small cap, mid cap indices, they have delivered close to 24-25% return. Does it mean you will not have large cap in your portfolio? The answer is clearly no, because large cap will give you a lot of comfort in an uncertain environment. So you need to have a decent exposure to large cap stocks in your portfolio. But to generate a better alpha, one has to be aligned to small and mid cap indices, where a lot of earning growth momentum is taking place. A lot of new sectors are emerging. Let's say, for example, EMS. This was one space which was non-existent a year back. But in last 6 months, we identified a lot of companies within the EMS spaces, and we have seen these stocks almost giving 100-150% kind of return in the last 7-8 months, which means there will be new theme which will come. If we are able to identify these themes which were non-existent 1 year back, actually you will generate very good alpha. But let's say if you don't have this kind of active portfolio style of investing, you might miss a lot of these new opportunities which are coming into play. So we believe that Techno Funda is an approach which is able to identify new themes, new trends which are emerging, and trying to exit out of themes which are going completely out of favor. So one such example which comes to my mind is IT as a space. In this entire rally which we have witnessed in the market, large cap IT stocks have actually corrected 15-17% in an environment where Nifty has delivered you good 12-15% kind of upside. But within IT also, there is a big change in trend which we are witnessing. So large cap ITs where they've corrected 13-15%, mid cap IT companies, let's take few names like Birlasoft, Persistent, KPIT Technologies. They have been consistently making fresh 52-week highs, and must have delivered close to 30% kind of absolute return in this same period when the broader Nifty IT is seeing a sharper correction, which means you have to identify a stock within a sector also which can give you a relative outperformance. And that's where we believe that Techno Funda style of investing is one such approach where we can have a higher win ratio and able to exit those stocks which are struggling to give you returns, or which are going to see sharper correction, so you can exit at an appropriate time.
And what about gold, Ashish? Do you find gold to be a good idea?
So Leena, if you look at gold from absolute perspective, gold has not delivered any significant return in a last 2-3 year period. So this was the levels we were last witnessed in 2021. We are in 2023. We are at the same level in gold. So I'm talking from a gold in dollar terms. Obviously, in rupee terms, we have seen some price up because of USD INR situation. But from a dollar perspective, gold is at the same level. Now, why it is trading at an all-time, trading at a higher level, but not seeing some significant jump. So it is trading higher because a lot of central governments, central banks hold significant amount of their holding in cash, in gold. And whenever they see that there is a dip in gold, they try to accumulate because they have to ultimately print money against this gold, and this balance will always be maintained. So that's the reason why at every dip you see a lot of interest which comes in gold. That is point number one. Second, in an inflationary environment, we think that gold is a natural hedge. So we are talking about crude commodities. They might see a significant jump because of Middle East, because of Russia, Ukraine, because of Hamas, Israel, all these issues. Ultimately, the best hedge in these kind of situation is gold, and that's the reason on every dip we see a lot of buying interest which comes to gold, and that's the reason around 1850 $1900 every time gold comes, we see a lot of support coming to gold. But at higher end, we don't see significant amount of momentum or price performance which is coming to gold. The simple reason is your bond yields are trading at multi-year high. So if 10-year GSEC is 10-year GSEC or 10-year Treasury is trading at a significant high level, then a lot of this money is going towards bond yields. So that's the reason at a higher end we are not seeing significant amount of liquidity which is chasing gold. We believe gold is going to remain in a band between 1850 1900 on downside to 2100 on upside. Till we don't see yields coming down, we don't expect gold to see some significant price behavior. But considering the kind of geopolitical risk we are witnessing, I think a reasonable allocation of 5 to 7% should be there in gold in your overall allocation or scheme of investments.
Great. Now tell us one more thing, Ashish. So, in about a decade, India is expected to grow to a $5 trillion economy. So now, in your opinion, where will this growth be most reflected in the stock markets?
Lina, if we look into this data point, we are going to move towards $5 trillion economy, eventually to $10 trillion economy. Our per capita income is going to grow from 2,600 to almost $5,000, $5,200 per capita income. This is ultimately going to see a disproportionate rise in the discretionary consumer spending, and that's where I think consumption or consumer space is one space where we are going to see some significant kind of wealth creation which we are going to witness at least in next one decade. If you look at the returns, so if you look at Nifty 50, it has delivered close to 14.7% kind of return in the last 5-year journey. Nifty mid cap 100 must have delivered close to 18-19% kind of CAGR return, and Nifty small cap has delivered almost 17% return, which clearly indicates small and mid cap space is going to see some serious opportunity in terms of wealth creation. Yes, in a shorter term time frame, we looked into one data which suggests that Nifty 50 as a percentage of total market cap has reached to a level of 40. So typically, whenever we see this level hitting a 40 level, so normally it used to trade in a range of 48 to 50 band, but because of the strong outperformance of small and mid cap in last 6-7 months period, this ratio of Nifty 50 versus total market cap has come to 40%. So in the shorter term, there is expectation that small and mid caps have rallied a lot. So there is going to be a relative outperformance which will come from Nifty 50. But if you look at the liquidity flow, so we are seeing a SIP flow of almost 16,000 crore on a monthly basis. Out of this monthly SIPs, the maximum amount is going towards flexi cap, small cap and mid cap funds. So which clearly indicates liquidity is going to chase small and mid cap in the medium to long term. And that's the reason I think a reasonable allocation between large cap, mid cap and small cap is the need of the hour. So ideally a flexi cap or a multi cap approach should be there. But yes, from a relative performance, from absolute performance, we believe small and mid cap is the space which is going to see some significant traction. To give you some data point, if you look at the number of companies who have joined the billion-dollar club, it has almost tripled in last decade. So this number was 164 companies in 10 years back. Now this number has reached to 468 companies, which means a lot of companies are actually trying to join the billion-dollar club. If you look at companies which are beyond more than 10 billion USD in terms of market cap, this was 19 a decade ago. Now that number has gone to 74. If you look at 25 billion USD companies, market cap companies, it was 7 a decade ago. Now it has come to 28, which means a lot of small and mid cap companies are actually going to become large cap companies in this transition phase, where the economy is going to move from 2.4, 2.5 trillion dollar to almost 5 trillion dollar economy. Also, we need to understand that corporate profit to GDP ratio in 2000, I would say 8, it reached a level of almost 8%. That number actually dropped to 1.8% in financial year 20, and now it is slowly recovering to 4.5%. So which means corporate profitability is going to see a significant jump. And if you look at Nifty's constituents, your I would say financials, banks, financials, they contribute close to 35% of the index weight. And if you look at the valuation, all these BFSI space has actually underperformed your broader market in last 1 year time frame. And this is despite we are trading at an 8-year low in terms of our NPA ratios. Our credit growth is almost at 12-year high period, which means we are seeing a strong credit growth momentum. We are seeing huge financialization of savings. So ultimately the CASA ratios are going to improve, and the capital adequacy ratios of banks are at a significantly higher level, which means banks and financials, which controls almost 35% of the index, is going to see a lot of profit growth, earning growth in days to come. And this sector has significantly underperformed. So we might see some significant outperformance coming from sectors like banking and financials. But but apart from banking and financials, I think it's going to be manufacturing sector, capex related theme, small and mid cap companies, which are going to see some strong relative outperformance. Where we are avoiding, so my sense is wherever we have got a global exposure, whether it's metals, whether it's oil, whether it's services sector like IT, I think there we might have to wait. It will take some reasonable time for these sectors to show some recovery. Even specialty chemical, for that matter, is going to see some period of sluggishness. So I think these are the sectors which one should be underweight in the current environment.
Great. And what about retail participation? I know SIPs are at an all-time high, etc. So is the retail participation actually comforting Nifty at lower levels?
Definitely, Reena. In fact, if you look at last 1 year price behavior of the market, it's very, very surprising. The kind of FIIs selling we witnessed in 2022-23 period, actually the same amount of selling if you would have seen somewhere 5 years, 7 years back, ideally Nifty should have corrected 20-25%. But because of a very strong retail participation, DII participation, we didn't see price correction happening into the broader market. Now, if you look at in 2023 CDSL, which has become a first depository to cross a milestone number of 9.6 crore demat accounts. So we have seen 9.6 crore demat accounts being opened. CDSL at this point of time has almost 51 lakh crore of stocks in its custody, and most of the retail participation is happening through CDSL as a depository. If you look at household debt as a percentage of GDP, we are around 14.7%. So that's also at a very comfortable level. If you look at gross SIP flow, the surprising part is the gross SIP flow is actually surpassing FII inflows in the last 3-year, 5-year, and 10-year data, which means there is a massive inflows which is happening. As I mentioned, 16,000 crore monthly SIP we have started witnessing. And the good part about SIP is, despite a lot of cyclicality which we see in other kind of flows, in the SIPs we have seen a very consistent rise. It has seen demonetization, it has seen COVID crisis, it has seen, I would say, the current global interest rate hikes. But in all these significant events, there is a consistent jump in the SIP inflows, which gives us an indication that the volatility or the cyclicality of SIPs have come down meaningfully, and this is going to support a lot to our market. Just to give you one more data point, the SIP accounts, it has tripled from 2.6 crore to almost 7 crore in 2023, and the SIP AUM has jumped from 8.5 lakh has jumped to almost 8.5 lakh crore from 2.5 lakh crore. So which means there's a significant AUM building which is happening through SIP, and that's going to support the trajectory of the market. So we firmly believe this is all getting reflected into the volatility data. We see a lot of events, but we don't see any meaningful correction. We don't see a Nifty breaking even 200-day moving average. All this is because we are seeing a significant traction coming from retail participation.
That's very reassuring. And now this is the closing question before we throw it open for our audience in case they have any specific queries they would like you to respond to. They can mention their questions in the chat box. So the closing questions now, Ashish, which was the most iconic development in the last 10 years? If you can name any one that changed the way businesses are currently being run in India.
So in fact, many, but yes, so maybe Aadhaar, UPI, I would say these are some very, very big step. And I would say unified payment interface is something which is at the forefront of, I would say, real-time payment transactions. So currently we do almost 260 billion users are there at this point of time for UPI. If you look at in the month of October itself, we saw almost 17 trillion rupee kind of transactions happening through UPI. So 50% of the GDP is happening. So basically, 50% of the GDP number is what we are seeing in terms of UPI transaction. Now, what it is creating? It is creating a strong, I would say, credit history for merchants, for customers, which will ultimately result into deeper penetration of I would say lending environment. And that's the reason RBI also is worried about the kind of personal loan growth we are witnessing. In fact, the personal loan or retail loan has actually crossed the corporate loan AUM. So which clearly indicates that because of UPI, there is a credit history which is getting created. There is a cashless economy which we are going to witness. We are going to see a digital economy because of UPI. So my sense is this is one event which is going to change the way we transact, the way we do the transaction, how the goods are going to move. All this is happening because of, I think, UPI. So UPI is one such big event which I think can change the direction. And that's the reason why a lot of these smaller finance banks or microfinance this is going to change a lot. Credit worthiness of lot of new millionaires, or I would say new age group, we are going to track it. And we all know that India is a young country. We are at 29 kind of median age. So a lot of these people are going to go for lending opportunities, and that's where UPI will play a very, very big role.
Great. So UPI is the most iconic. So thank you so much, Ashish. So these are some of the questions which we felt were common across our clients. May I request the audience, if you have anything else that you would like Ashish to cover, please type your question in the meeting chat. So while the audience are evaluating what queries they want to have or typing it, Ashish, are there any other significant things that you feel that I may have missed out on asking you that you feel you should share?
Sure, Lina. So as a lot of people are worried about the current set of volatility which we are hearing, but we need to understand this is not getting reflected into the price behavior. And we firmly believe that market is a great discounting machine. So if all these news flow, negative news flows are actually not getting reflected into the price, it means somewhere the market is actually discounting it, and a lot of these dips are actually giving opportunity to go long on dips. And this is our belief that from a valuation perspective also, if you look at on a forward basis, we are trading at around 18.9 times versus a 10-year, 15-year average of 20 times. There is a lot of question about small cap, mid caps, which have seen a very sharp rally in the last 7 months. But if you look at from a valuation perspective, small mid cap indices are trading at a 15 forward PE multiple. Again, if you look at 10-year, 15-year average, most of these indices are trading at a 15.5 kind of 10-year, 15-year average, which means small and mid caps are at their 10-year, 15-year averages. We have not seen some significant PE expansion happening in small and mid cap. Only thing is that from 2018-19 to 2023, there was a lot of underperformance which the small and mid cap space were witnessing. And in last 7 months, it has actually tried to see some recovery. So we are seeing a very short-term time frame where in the last 6-7 months, they have seen a significant jump. But if you look at from 2018 to 2023 period, there is hardly 5 to 6% kind of CAGR the small or mid cap would have done. So our sense is there is a lot of room, lot of scope for them to rally. Maybe some price correction or time correction can happen, but it is not going to stop in the longer term time frame.
That's great to know. Thank you so much, Ashish, for sharing that. It seems that we have pretty much covered everything that our audience would have liked to understand. And should there be any other queries that our clients may feel they have, please reach out to Ashish through your relationship manager, and he'll be more than happy to get on a call and share any specific queries you may have. So thank you so much. Really appreciate your time. Again, apologies for the initial snag with technology, and season's greetings and a very happy Diwali to you and your family. Thank you so much.
Thank you, Nina, and wish you all a very happy Diwali. Thank you.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.